Hi, I'm Steve Dudash at IGT Wealth Management. Welcome to this week's Wealthcast. So, I want to focus on the big news that came out of the government this week, earlier this week. The Federal Reserve raised interest rates for the third time in 12 months. There's actually a fourth one coming later this year, and probably 2 or 3 are coming next year. But it's a good thing. It really is a good thing. One, it was telegraphed so well that everyone knew it was coming, so it's not like there was a surprise on this at all. So that's always, transparency always helps in that world. But two, it shows that our economy, and I know it's been slow, but our economy is rebounding well. It's been 8 or 9 years now since the Great Recession, and yet we keep plugging along, getting a little bit better, a little bit better, a little bit better. Not this whole boom and bust cycle, but progressively getting better. Inflation's low, maybe a little too low, but in the right range. Unemployment. How many years in a row there did we have unemployment numbers that were just way too high, flat out, just way, way too high? We're actually at the point where you can start to make the argument we're too low, which again is a good reason why they should raise rates a little bit for future ammunition, slow that down a little bit. But most importantly, it reinforces that our economy is doing well, that we're rebounding nice, that Europeans' economy is doing well, that emerging markets economies, China kind of, are doing much better, and that gives our Federal Reserve the leeway of raising rates without dampening the world economy, which hurts us too much. It's good for retirees. They're starting to earn slightly more on their interest-bearing accounts. It's not really the greatest for people who are, who have debt or taking out loans or buying things like businesses or whatever. It's not the greatest for that, but because the interest rate hikes have been so small, 25 basis points each time, and because the long-term rates really haven't moved too much, it hasn't really had that much of a negative effect on that side of it. But the one thing I did want to focus on, and the one part of this that I don't think gets enough press, is how well our economy has done because of how low we've been able to keep oil prices down. OPEC, about 12 months ago or whatever, came out and really said we're cutting rates. They actually did cut production. They really did cut production, and in order to try to prop up oil prices. And it's been impressive how well our in-house production, mostly shale production, has filled that void in such a short period of time, and really has negated virtually the entire production cut that's been out there. If that continues 5 years, 10 years from now, we're going to look back and point a finger and say that was the reason why our economy went on such a nice run for such a long period of time, because I don't care how you spin it, oil is a tax on the economy for the most part. Not energy companies, but for everybody else it's a tax. And if we can keep those prices down with in-house production, very nice benefits that come out of that. So hopefully that can continue. Hopefully that clarifies a little bit what's going on with the Federal Reserve. If you have any questions, call, email, Twitter, anytime, and reach out to us whenever you have any questions, and have a nice weekend. Take care.